What's going on, guys? Welcome back to the channel. My name is Leo. I'm a value investor. In today's video, we are analyzing Nvidia. We're going to do a comprehensive analysis looking at the numbers of this business. So by the end of this video, you'll know whether Nvidia is over or undervalued and if it's a great buy or not. And if you've been a subscriber for quite some time, I appreciate you, I love you, and I apologize for not being around. Life kind of gets kind of crazy. But with that being said, let's jump into the video. I'm going to load up the stock spec software. So if you're new to the channel, this is a software that I like to use to analyze companies. 7-day free trial. Follow the links in the description box below. I'm going to type in Nvidia stock symbol, and the software is going to load up everything about this company. And so here is the software. I have Nvidia pulled up. The current price is $425. Absolutely insane. I've covered this company a bunch, and I said south of 200, it might look like a pretty decent company. However, I think it needed to go a little bit lower. We hit actually a low of 108 at some point, folks, in the 52-week range. Now, currently, we're sitting at 425, and that's a $300 run up for this business. Now, does that mean that this company is worth pretty much 3 times more? Not necessarily, because here's the thing, folks. You're currently paying, and I'll show you what the software is pulling up, for the price earnings ratio for the trailing 12 months, 219 times their earnings to own this business, where on average, their PE ratio is sitting at 63.95. Now, look, folks, a 63.95 price earnings ratio for any company is a premium. Now, factor that into Nvidia being at 200, you are paying through the nose for this business. Is it worth it? Based off this one metric alone, I would say no. But, however, there's a lot of other facets to take a look at. Take a look at this. So, in the financial evaluations category of this software, and this piece of software takes a look at the company's financial statements of how they've improved or, let's say, declined over the course of the last 5 years and what they've been shown to have performed on average. It's grading this an 8 out of 10. And so these 10 specific metrics here that I like to take a look at showcase how well this company's performing. Obviously, it's getting a point deducted in the price earnings ratio because it's sitting at 63, which is extremely high, sitting at a premium, and the debt to equity ratio with a 53.64 percentage in debt to equity. Honestly, the debt to equity ratio is not the worst thing. The software likes to favor companies that have a debt to equity ratio of 50% and lower, because ultimately you want to find companies that are leveraging their assets. They're leveraging their capital through equity and not taking on debt. Especially now during this economic climate where we're in higher interest rates, where debt is now more expensive to pay off. Because now eventually if interest rates keep going higher and higher, to pay off that debt is going to be a lot more difficult, and to borrow, and if you're a company that's borrowing a lot, that is going to hurt your bottom line a lot more. Now, everything else with this business is looking really good. They have a high current ratio. It's sitting at 3.43, not too high, but above 2, which is great. The return on equity is high. Obviously, it's a tech company, so it should be sitting around 30%. EPS growth is 76% over the last 5 years. So if you've been holding this company, you should be very happy about that. The share dilution is actually down by 0.36%, not a huge drop. So that means they've been buying back shares, which is something you want to see because that decreases dilution. The net income is up, the free cash flow is up, and the return on invested capital is a whopping 22%. So that means to refinance this business and to grow this business, their capital that's been invested is going to stretch higher and longer, and as well as their revenue growth is up by 25% over the last 5 years. So we're seeing a lot of improvements with this business. However, the one thing, as I said, that concerns me is this massive price increase. Now, honestly, when I see a massive price increase like this, I think to myself, it's not really a buy for me. And honestly, I pretty much stand by that in regards to Nvidia. I do think, and I have to retract whatever I said in my previous analysis videos, I do think it may have been a buy maybe around this 125 range. And honestly, I think I stand by that. I think in the 130 range to 120 range, it could have been a decent buy. I think the PE ratios was just a little bit too high for my liking. And you know what? I may have been greedy and I may have missed this. However, I think personally going forward now, this is definitely not the time to buy it. However, let's take a look at the deeper numbers and see if that still holds true. Right now, they have an Almond Z score of 35, which is phenomenal. That means they have no risk of going bankrupt. So if you have any concern about this company going bankrupt, you don't have to worry about that. The return on invested capital for the trailing 12 months, it's dipped a little bit from their 5-year average, sitting at 12.58, but it's still pretty strong. On average, the free cash flow comes out to be $4.8 billion. They do also pay out a dividend, which is a very small dividend, 0.04%, not much. It works out to be $400 million, which is easily able to be covered by their 5-year free cash flow, as well as currently their free cash flow is sitting at $5.1 billion. So the dividend is safe. You don't have to worry about that. It's a tech company. Tech companies typically don't have higher dividend payments because ultimately they're trying to reinvest back into themselves to fuel more R&D so that they can continuously grow and innovate to get larger and larger and larger. Now, amongst that, so my thoughts on Nvidia is simply this. I think it's definitely a strong company. I've never said it wasn't. In my previous videos, it's pretty much either scored a 7 or an 8 or even a 9 at some point in certain categories. It's definitely a strong business. Now, what should we be paying for this company today? In this software here, and if you want to get your hands on the software, folks, follow the links in the description box below. You get a 7-day free trial. It comes with an intrinsic value calculator and labeled price analysis. So what I can do here is I can do up to 20 years of analysis. I'll do 7 to 10 years because that's ideally how long I plan on holding any kind of stock before I make a decision to sell. And I can do 3 different analysis and find out what we should be paying for this company today. So based off the historic numbers of this company, where last year it only grew 0.22%, 0.22%, I'm going to try to make some conservative estimates of what I believe this company might do over the next 10 years and see what we'll come up with, what we should be paying for this company today. So stand by while I fill out these boxes. So folks, if you're enjoying the video so far, hit that like button and subscribe button. I'll show you what I did with Nvidia. I put some pretty decent conservative numbers for this company. I mean, it's somewhat aggressive. I'm gonna be honest with you. I put some earlier numbers in, and I think it was way too conservative. So I decided to go with 10, 15, and 20%. I'll show you what that looks like. The earlier numbers I put in, 3, 5, and 7, came out to a average calculation of $38. Now I'm gonna say, look, I think even though based off their share price being $425, the revenue still has some room to grow. I don't think you should be paying that low for this company. It's really hyper conservative, but I think a 10% revenue growth over the next 10 years with a 16% profit margin as they've shown in the last year, as well as a free cash flow margin if it stays the same for the last 1 year, with conservative price to free cash flow, price earnings ratio, it should turn out to be a decent price. So this is going to crunch all of these 3 numbers and see what we should be paying for this company today. And here it is. It's a little bit better than what I showcased earlier, but average calculation comes out to be $103.60. Now you might be saying, Leo, how can you even figure out, or how can you even think that that's possible to be paying that low for a company such as this? Guys, we weren't that far off. The 52-week range, we got down to 108.13. And ultimately, folks, if you are a value investor or a investor in general, you have to figure in like the fact that you have to pay a decent price for companies. If you're overpaying for a business, what's your actual return? You understand? You have to understand that if you are overpaying for a business that isn't well performing, you are just getting ripped off. Now let's actually just investigate Nvidia for a second. I said that there was revenue growth for 25% revenue growth over the last 5 years. Free cash flow is up 21% over the last 5 years. But like, if you go into their income statements and actually take a look on an annual basis of what that revenue growth and free cash flow actually looks like, take a look at this. In 2017, just about 5 years ago, was $6.91 billion of revenue. Currently, we're at $26.97 billion of revenue. That is nothing for a $1 trillion company. Absolutely nothing. I'm going to pull up Apple in a quick second. Let me see if I can just get another. We'll do this. We'll load up another window here, and I'll show you what Apple's looking like. I'll open up another stock specs window, but take a look at this. 2.97. Actually, you know what? Apple's a terrible example because Apple is a $3 trillion company. Let's load up Intel instead. So it's going to load up Intel and see what that looks like. But currently, the revenue is $26.97 billion. Go over to the free cash flow statement, and that is looking. Where's the free cash flow? Currently, it's at $2.66 billion. Oh, that's a quarterly basis. Show me annual, please. $3.81 billion, 8.13, 4.69, 4.27, 3.14 billion. So it's gradually been going up, the free cash flow, but it's still extremely low. Now let me show you Intel just for a quick example to see what that looks like. Go to their income statement. Their revenue is $63 billion for 2022, $79 billion for 2021, $77 for 2020. And if you look at Intel's market cap, it's a $132 billion market cap. Just keep that in mind, folks. Keep that in mind that Intel is a fraction. It's 1/10 of Nvidia's market cap, but it's bringing in probably, was it double the revenue? Is that what we said? Revenue 26 billion, 20, let's call it $27 billion, and Intel is at what? Yeah, pretty much double the revenue. Call it I'll even give it 30 billion for Nvidia. Currently, it's bringing in double the revenue. Now, granted, yes, maybe Nvidia is more experimental. Maybe they are more technologically advanced than Intel. However, from a business perspective, Intel is the better business. Does that make sense? They are performing way better for what you're paying for than Nvidia. Nvidia at its current price does not make any sense based off the numerics that are coming in. You are overpaying for their revenue. You're overpaying for the free cash flow. It just doesn't make sense. Right now, it is in a hype stock territory, in my opinion. A lot of people might disagree with me, but the numbers speak for themselves. You're getting a fraction of the price paying for Intel in terms of what the share price is going for, and double the revenue. And just to further explain that, let's go to the cash flow statement on Intel. Sorry, this is Nvidia. Let's go to the cash flow statement. Let's take a look at that on an annual basis. So they're actually down. They're down for 2022 in the negatives, but the prior years is $9.66 billion, $20 billion, $16 billion, high numbers. I know this free cash flow is due to the fact that they've actually been reinvesting into this business, into building their other plants. Granted, it's a negative number, but it just goes to show that stock price isn't everything, and especially people that are jumping on the hype, that's something to watch out for. So if you enjoyed this video, folks, and you found this super helpful, drop a like, drop a subscribe button, hit the subscribe button. I'll do more analysis videos in the future, but here's the thing, folks. Nvidia, where it currently stands, way too overpriced. I'm not saying go out and buy Intel, but definitely think twice before you jump into a company that's had, one, a major run up, and two, sitting at a extremely high price earnings ratio, and three, if it's not a company that's checking out on the stock spec software. This software has been phenomenal for a lot of picks that I've personally bought. I bought into Google at $94, and I bought in at Meta, Facebook. I think my average price is $160, but I did that by using conservative estimates, and I use this software to help me get there, to make more rational choices. It's simply numbers, folks. It doesn't have to be that hard. Don't let your emotions get in the way. That's my one piece of advice. I'll see you in the next video. Thank you so much for watching.